Let's pull back the curtain on an invisible machine. Today, in this explainer, we're going to reveal exactly how the financial system takes your hard-earned cash and turns it into billions in profit for themselves. If you've ever stared at your savings account and just wondered why your balance barely inches up while banks are out there reporting absolute record earnings year after year, well, you're definitely in the right place.
Seriously, think about it for a second. While your money is just sitting there, allegedly safe and sound in a savings account, who is really getting rich off of it? We're all taught from day one to lock our money in a vault for safekeeping, basically trading access to our own cash for a tiny, tiny fraction of a percent in interest. But your money, it isn't just sitting there gathering dust. It's actually working incredibly hard. It's just not working for you.
To really wrap our heads around how this works, think about the global coffee trade. Picture a farm thousands of miles away, maybe in Brazil or Ethiopia. Now, the farmer who actually grows the beans, the person doing all the back-breaking physical labor out in the hot sun, they only earn about $5 to $7 for every $100 of coffee sold. So where does the other $90+ go? It goes straight to the middlemen, the traders, the exporters, the big corporate brands. The middleman, who literally never touches a single bean, makes an absolute fortune, while the person doing the actual physical work is left with pennies. And here's the kicker. This dynamic perfectly mirrors our modern financial system. In this scenario, you are the farmer. You commute, you put in the long hours, you do all the heavy lifting to earn your paycheck. And the bank? Well, they're the ultimate middleman. They take the fruits of your labor, your deposits, and they package them, move them around, and lend them out. They capture almost all the profit without ever actually producing a single dime themselves. So here is their exact playbook. Step 1, you deposit your money, totally trusting the bank to keep it safe. But the absolute second you walk out those double doors, the bank turns right around and loans your money out. They lend it to businesses trying to expand or to people buying new homes. Essentially, they're crowdsourcing your deposits to fund these massive, highly profitable loans. So they're building wealth for themselves while tossing you just a few measly cents in return. To truly grasp the mind-boggling scale of this machine, let's look at some numbers. In the United States alone, there's roughly $50 trillion in total credit moving through the system right now. But actual physical money, like paper bills and coins, there's only about $3 trillion. Let that sink in. That means the vast majority of the money you think exists out there in the world doesn't. It's entirely digital, and it's built on nothing but promises. Which brings us to a mind-blowing reality of our modern economy. Most of what we call money is actually just credit, created completely out of thin air. Think about it like this. When you buy a beer at a bar using a credit card, you are basically starting a tap. You and the bartender just manifest a debt and an asset out of absolutely nothing. Private banks do this exact same thing, but on a multi-trillion-dollar scale, effectively expanding the entire economy through credit. But you might be wondering, who actually controls all this invisible money? Towering above all these private retail banks is the central bank, the Federal Reserve. And they control the flow of all this credit using a massive economic lever, interest rates. By offering short-term loans through things like the discount window, the Fed essentially sets the baseline price of borrowing money for the entire country. By pushing this interest rate lever up or down, the Fed gets to dictate exactly how expensive it is for banks to borrow. When rates are lowered, borrowing gets cheap. Businesses and everyday households spend more, which speeds up the whole economy. But when rates go up, borrowing becomes super expensive, slowing spending down to cool off inflation. Basically, the Fed is in the driver's seat, pressing the gas or slamming on the brakes for the entire U.S. economy. Now, because banks are aggressively lending out money that they technically don't have on hand, the whole system is inherently pretty risky. That's exactly why the Fed has to step in as a strict supervisor. They establish intense rules and run stress tests to make sure banks are operating safely. Because without this supervision, we'd see massive, panic-driven bank runs. And that's what happens when everyone tries to withdraw their cash at the exact same time, only to find out the vault is completely empty. But even with rules, eventually the debt builds up way too much. The bubble bursts, and we slam headfirst into a brick wall. This triggers a really painful economic phase known as deleveraging. Think back to the crash of 1929 or the 2008 housing crisis. Borrowers suddenly can't pay their loans. Credit just evaporates, assets get sold off in a sheer panic, and the stock and real estate markets crash violently. When a catastrophic crash like this happens, just lowering interest rates doesn't cut it anymore, mostly because they usually hit 0% pretty fast. So, the central bank smashes the panic button,
They pull out their ultimate weapon, literally printing new money out of thin air. They use these freshly printed digital dollars to buy up financial assets like government bonds. This injects massive amounts of cash directly into the paralyzed banking system, just to keep it on life support.
Now, pay close attention to what happens next. While printing money absolutely saves the banking system and prevents a total societal collapse, it comes with a massive side effect. Because the central bank is out there aggressively buying financial assets, it disproportionately inflates the value of things like stocks and bonds. And who owns the vast, vast majority of stocks and bonds? The wealthiest 1%. So their net worth skyrockets, while the everyday earner sees almost zero benefit. Ultimately, this creates a stark, systemic wealth gap. And look, it's not some grand, shady conspiracy. It's literally just the mechanical reality of how credit cycles work. By relying on asset purchases and credit expansion just to survive, the financial system naturally and inevitably widens the gap between the haves and the have-nots over time. Okay, so knowing all of this, how do everyday people actually fight back? How do you stop being the underpaid farmer in this equation? Well, you can start by changing exactly where you put your cash. You might want to skip those massive for-profit global corporate banks that give you terrible savings yields and hit you with high fees. Instead, consider local credit unions. Because credit unions are not for profit and owned by their members, they typically funnel those middleman profits right back to you in the form of much higher savings rates and way lower fees. But you can also take it a step further and bypass the traditional bank middleman entirely. You can utilize money market accounts for higher yields or take your hard-earned money directly to the financial markets. By buying bonds, you essentially become the lender, earning the interest yourself. By buying stocks, you share directly in the profits of businesses. You take on the risk, sure, but the trade-off is that you actually get to keep the middleman's cut. We've just seen how this grand machine of credit, central banks, and interest rates actually operates. We've seen how it naturally funnels wealth upward, literally using your deposits as the fuel to do it. So now that you know exactly how the financial system turns your hard-earned money into their billions, you have to ask yourself one very important question. Where is your money sleeping tonight? Is it working for you, or is it working for them?